Welcome to the Audit Guidebook. Today, we are going to break down the 10 fundamental accounting principles. Look, whether you're a student just starting out or a seasoned pro looking for a refresher, mastering these rules is absolutely non-negotiable for a career in audit. This explainer is part of our Module 5 accounting series, and we've designed it for pretty much everyone on the professional path. So if you're a student aiming to get into the field, a new auditor learning the ropes, or even an experienced professional who just wants a sharp, practical tune-up, you are in the right place. So here's our game plan. First, we'll walk through the 10 foundational principles one by one. Then we're going to put that new knowledge to the test with a quick quiz. After that, we'll review the answers together. And finally, and this is the important part, we'll connect all of it back to why this stuff is so critical for every single auditor out there. Okay, let's dive right in. Now, these 10 principles, they aren't just helpful suggestions. Think of them as the absolute bedrock of financial reporting. They are the rules of the game that ensure financial statements are consistent, reliable, and you can actually compare them. Without these, it would just be chaos. First up, we have the Entity Principle. This one's super simple but incredibly important. The business is its own person, totally separate from its owners. That means the owner's personal grocery bill can't be logged as a business expense. This clean separation is what keeps the business's books clear and unbiased. Next is the Money Measurement Principle. Here's the deal. Accounting speaks one language, and that language is money. If you can't put a dollar, euro, or yen value on something, it doesn't go in the financial statements. So while your team's amazing morale is obviously super valuable, you're not going to find it listed as an asset on the balance sheet. The going concern principle. You can think of this as a default optimistic assumption. We always assume a business is going to keep on operating for the foreseeable future. And this really matters for valuation. Because we assume it's not about to shut down, we value its assets at what we paid for them. Their cost, not at some fire sale price if we had to liquidate everything tomorrow. And that leads us perfectly into the cost principle. Assets are put on the books at their original historical purchase price. You know, the market value of a building might go up and down like a yo-yo, but the price you paid for it, that's a solid, verifiable fact. This principle makes a clear choice. It goes for reliability over the often changing relevance of market values. The dual aspect principle. This is the very engine that makes accounting run. Every single transaction has two equal and opposite effects. A debit in one account always means a credit in another. It's the reason why that fundamental accounting equation, assets equal liabilities plus equity, has to and always will stay in perfect balance. No exceptions. Okay, let's talk about two principles that are all about timing, accrual and realization. The realization principle says you record revenue when you've actually earned it, like when you've delivered the goods, not necessarily when you get the cash. And the accrual principle is the flip side. You record expenses when they happen, not when you pay the bill. When you put them together, they perfectly match your revenues to the expenses that helped create them, giving you a much more accurate picture of profit. Now, for two principles that are all about good judgment. Consistency is pretty straightforward. A company needs to use the same accounting methods year after year. Why? So you can make meaningful apples-to-apples comparisons over time. Then there's prudence, which some people call conservatism. It basically tells us to be cautious. You should record potential losses as soon as they seem likely, but you should only record gains when they're a sure thing. It's about not getting ahead of yourself and overstating the company's health. And finally, we have the Materiality Principle. This is where an auditor's professional judgment really comes into play. You have to focus on information that's significant enough to actually influence an investor's decision. I mean, a $10 rounding error on office supplies? For a huge corporation, that's not material. $1 million error in revenue? Oh yeah, that is absolutely material. It's all about focusing on what really truly matters.
All right, you've seen the principles. Now it's time to see if they've stuck. Let's do a quick knowledge check to see how these concepts are landing. Ready?
Question 1. Which principle is all about treating the business as a separate thing from its owner? Next up, question 2. The principle that assumes a business is going to be around for a long time is called what? Moving on to number 3. Assets should be recorded at their original purchase cost. According to which principle? Okay, for this one, you're looking for a pair of principles. Which two rules are all about the timing of recording revenues and expenses and don't really care when the cash actually moves? And our last question is a fill in the blanks. Applying the same accounting methods over time is called blank, while recognizing probable losses as soon as possible is called blank. Which pair fits in there? Okay, pencils down. Time's up. Let's go through the answers together and make sure these key ideas are locked in. For our first set, separating the business from its owner, that's the entity principle. Assuming the business will keep operating, that's going concern. Recording assets at what you paid for them is the cost principle. And the whole debit and credit balancing act, that's the dual aspect principle. All right, let's keep it rolling. Recording revenue only when it's earned is the realization principle. Focusing just on the significant stuff is materiality. Using the same methods every year is consistency. And being cautious by recognizing losses early, that's prudence. Hope you're doing great. And for our last two, only recording transactions you can put a dollar value on, that's the money measurement principle. And its partner, recording expenses as they happen, that's the accrual principle. Fantastic work. So let's bring this all home. We've gone through the theory, you aced the quiz, but why does this matter so much? Why is having a rock-solid grasp of these principles so critical for your career, whether you're an internal or an external auditor? Here's the bottom line. These principles are the universal language of business. As an external auditor, you simply cannot form an audit opinion without testing against these rules. They're your yardstick. And for an internal auditor, they're the framework you use to see if internal controls are working and if the company is playing by the rules. The crucial point is this: whether you're inside the company or outside, mastery of these principles is completely non-negotiable. It's what makes you a credible professional. And that's a wrap on our breakdown of the basic accounting principles. If you found this useful, do me a favor and hit that like button. And be sure to subscribe to the Audit Guidebook for more deep dives into core audit concepts. Remember what we're all about here. We want to help you learn the material, apply it effectively, and advance in your career. Thanks for watching, and I'll see you in the next one.